All right, perfect. Looks like we got Robert on the call here too. We'll jump back in. My name is Alex Rogers. I'm with Great Up Capital. I have business partner Frank Rush on the call as well, and Bobby here with On Call Capital. We are real estate professionals. We've been working in real estate for the past 12 years. Frank and I started right out of college, investing in smaller assets in northern Minnesota. Slowly grew our portfolio organically, opened a property management business in 2014, opened our construction company in 2018, and started building our capital business in 2021. Last year, we closed on a 112 unit acquisition portfolio in Duluth for $14 million. And today we have just over 30 individuals employed across our different organizations. And today we're excited to discuss Windsor Court Apartments with you. Located in Robbinsdale, Minnesota, submarket of Minneapolis, Minnesota, a first ring suburb, lies 3 apartment community buildings and 1 exterior garage building. Built in 1963, there is a unit mix of primarily 2-bedroom units. There is 1 1-bedroom and 1 3-bedroom, accompanying those other 82 2-bedroom units. Over the past 5 years that the seller has owned the asset, they've poured in a lot of money into different capital improvements. The windows have been replaced prior to the seller acquiring the asset, but the seller has replaced all the roofs, warranted. He's done a lot of landscaping, redone the parking lot, and has updated many of the common areas and units. However, we feel that his level of finish for a lot of the units improvements is kind of what allows us to have some really strong value add opportunity with the apartment buildings. We're going to touch on a lot more of the business plan here in a second, including the different improvements that we plan to execute on the site here in a second. But I wanted to go through the debt structure on the acquisition. We're working with Bridgewater Bank, which is a local community bank in Minneapolis. They are primarily real estate based. That's their major asset. They do a lot of it and they do it really well. We are acquiring the site with an 80% loan to cost, and our term is initially a 5-year fixed rate loan, kind of a mini perm. So we have an 18-month period of interest only. After interest 18 months, it will begin amortizing fully. Our interest rate is based off the 5-year treasury, which gives us a lot of favorable terms over normal debt markets, with an amortization rate of 30 years. We have a 5 and 5-year term. So we have an initial 5-year period fixed rate. And after 5 years, if we need to extend for any additional time, we have an additional 5 years baked in as well. So it can be up to a 10-year fixed rate loan. Let me let in this other person here. Okay. To all of the limited partners, all the passive investors in the deal, it is non-recourse. No passive investors will need to sign on the loan. After the 18-month period, like we discussed, the loan does become fully amortizing at that 30-year term. So we're going to briefly touch on some of the aspects that we really like about the asset. Outside of the fact that it cash flows really well day one with in-place rents, which is something that we require as part of our pre-screening of every asset that we underwrite. The property had many strong attributes. There wasn't a ton of deferred maintenance. It's been really well kept for the vintage of the apartment community. But first and foremost, we saw that the current owner really took a lot of pride in keeping it 100% occupied. And because of that, he also had his rents well below market. It looked like he didn't really keep up with renewals on the leases. So basically somebody would sign a lease and then they'll just coast primarily at that same lease rate. So most important aspect of our business plan is really instituting effective property management. We are working with partners in the Minneapolis metro area that has executed the same plan numerous times. They're Line Rock Property Management. They are also part of our general partnership. So we have maximum alignment of interest to ensure that our business plan does get executed on the timetable that we require. And what comes along with that is just proactive and high touch property management. We are going to be implementing a strategic improvement process to these units. Hold on one second, get a little feedback. All right, there we go. Part of the oversight of the business plan that the property management firm, along with our asset management firm, will be overseeing is the strategic improvements to both common areas and units. The seller has completed a number of different upgrades and level of improvements within the common area, within the units. For instance, on the screen, you can see a bathroom that they renovated recently. They have beautiful subway tile all around the bathroom, new flooring. However, they installed some very basic, like flattened panels and some 1990s chrome light fixtures and 1990s chrome faucets as well. So our plan is to go through and make strategic updates to different trims and finishes, plumbing fixtures, light fixtures that modernize the apartments without having to do too much of a heavy lift of the interiors. We'll also be updating cabinetry hardware, fresh paint flooring, and stainless appliances throughout the interior units as well. That will allow it to compete with that next class up of apartment community. And then the third aspect that we will be undertaking is rebranding the community too, which is a pretty common aspect to build a new identity for this community to the general public. We also expect to provide some newer amenities to the common areas that will benefit our tenant base. So adding a dog run, improving the exterior landscaping, providing a outdoor gathering space for the tenants to gather, a pergola grill area, which really makes the community feel more of a home for our residents. And now I'd like to discuss some of the high-level aspects of the investment overview. This is a 506C offering currently with a minimum investment of $25,000. Our expected time horizon is just about 5 years, 3 to 6 years. We are offering a 7% preferred return with the waterfall structure that follows. Right now, we're anticipating internal rate of returns for our passive investors greater than 19% with equity multiples greater than 2.1. Our in-place cash flows are just above 7%. And after we stabilize the asset and execute our strategy and stabilize and optimize NOI, we're anticipating cash on cash greater than 10%. Our underwriting shows an expansion of the cap rate of about 75 bips from entry to exit. So we're conservative on that regard, just as is common with our underwriting criteria. And we're underwriting pretty conservative vacancy and after renovation rents. The market is probably conservatively around $1,500 a month in rent for this type of product after renovation. We underwrote $1,400. And below, you can see a sample investment scenario of $100,000. You notice that year 1 and year 2, we see growth in distributions to our investor partners, while there's a decrease in expected distributions in year 3. That is because of the amortization of our debt starting at month 19. And with that, we'll open up to some questions at this time. So I think everybody should have the ability to unmute their microphone. If you don't, feel free to raise your hand or throw something in chat and we can go through that together.
Yeah, I've got one in the chat. It is, what strategies are in place if interest rates are very high in 5 years and we aren't able to hit our sale projections? That's from John.
Yeah, thanks, John. We right now we are anticipating exiting the assets between year 3 and 6, year 3 and 5, really. Conservatively, we want to we build in our runway with our debt in case there is a major shift in the macroeconomics where it's not favorable to dispose. Today, because we have such anticipated and really high in-place cash flow, we're going to be able to weather any type of shift in really the macroeconomic environment, that even with increased rates in 5 years, if there are increased rates in 5 years and we choose to activate another 5-year period on our debt, our cash flow will be able to withstand that pretty easily. But we do expect to dispose of the asset upon optimizing our NOI. Good question, though. If you do have questions, feel free to throw it in the chat or to, unmute and we can have a discussion too. Whatever anybody's comfortable with.
And I do know one of the questions I've gotten is, are you putting your own money into the deal? I am. I will be putting in money into this deal. And so that's something that I've been asked quite a bit.
And Frank and I always put a significant amount of capital in. Our minimum is usually 10%. I think right now we have 500 that we're putting into this deal.
So Robert Band has a question. What rent growth percentage are you using across the holding period and how do you arrive at that?
Great question. I was just talking to a operator out of Ohio that has seen different syndicators use rent growth projections of kind of 10% as their underwriting model, kind of year over year. We don't underwrite like that for rent growth projections. We underwrite usually at 2 or 3% increases across the board, with generally a slightly higher increase inflationary growth for expenses. So we're 3% usually for our rent growth that we factor in.
And then I think the follow-up was, how do you arrive at that? How do you come up with that number? Where does that come from?
It's just a conservative expectation. We know that there will be some growth, but we don't price in as far as 10%. Up until really the recent, inflationary concerns that we've seen in the environment, we generally price to kind of what the average inflation rate is for our rent rate growth.
All right. Other questions? I know I've had some investors ask me about the Waterfall Hurdle, what exactly it is, and how that actually works.
Absolutely.
So,
First thing to understand and to clarify is that another question here from John.
We do have some other questions. Yeah, we'll get to those. Yeah.
Yeah, let me touch briefly on the waterfall, and then we can go to these other questions that just popped up. The internal rate of return of any investment can't be determined until the exit of an asset. For the holding period, we have the 7% pref that we will make. Anything over and above the 7%, which looks like there might be some distributions that do exceed that pref, will be a return of capital. At the end of the exit of the investment, you go based off of what the actual cash flows are, up to different hurdles of the internal rate of return. And Frank, I think you have a really great analogy of how to explain that. Do you want to take a stab?
Yeah, I mean, I always think of it as kind of different buckets. So you've got that main bucket which is just the preferred return. So that's 7%. So once money starts flowing out of the investment, it's going to hit that first bucket, that preferred return, and it's going to fill up that bucket. And until it fills it up, that's the only place that money is going to go to. Once it's full, then it's going to flow into that next bucket. And that's where you kind of get the term waterfall. So does that kind of help where you're going there?
Definitely. And then after the first bucket is filled, as Frank was alluding to, anything up to the 13% internal rate of return, those cash flows are split 75% with limited partners and 25% with the general partners. After it exceeds the 17%, then the split kind of continues and so on with internal rate of return. Anything above 17% is split 40% to the general partnership and 60% to limited partners.
Align interests as well, gives the general partnership a good alignment of interest with the limited partners to better the deal performs. That's really when the general partner, makes its money there.
Exactly. We have rent growth looks like it's 10% below the market. So is year one rent growth higher than 3%? Robert, yep. So we look at, we blend our rental rates based off of the aftermarket rents that we will re-tenant at after we make the improvements to the business plan. So let's say month 2, tenant moves out, we execute the plan, we improve the unit, and we re-tenant at the market rate of $1,400 per rent. The current rents are $1,100, and actually they're a little bit higher now because there's a lot of rent growth expansion in the rent roll between when we underwrote in February and today. But when we re-tenant, it'll be jumping from whatever market rate they're at between $1,100 and $1,200 to the $1,400 per month. So the rent growth is for year one in general for the overall project is higher than 10%, or I'm sorry, is higher than the 3%. And John, you're asking about distributions. Luckily, this project, I think, would certainly not be considered a larger renovation. These are really tactical improvements to the units with some nicer improvements on the exterior. We are conservatively planning on starting monthly distributions month 6, and it could start sooner than that. Again, in-place cash flows with our current debt structure. It is a mini perm, which means that we're financing in a number of the improvements to cash flow from day one.
Other questions? Feel free to unmute yourself or type in the chat.
Yeah, and one thing that we get asked pretty frequently about these types of investments is the liquidity. Unlike the stock market, you can't just subscribe to the offering and then try to sell back on the open market. It's an illiquid asset. To make a decision to invest in an offering like this, it is critical to understand that you will want to hold on to it for the period of the term. You want to plan for that.
So, go ahead, Frank.
Yeah, and that's really why I like investing in real estate. You see the higher returns versus the stock market, but that is the one drawback. One negative is it's not liquid, so it's something that's gonna be illiquid for 2, 3, 4 years, whatever the deal takes. Yeah.
Exactly. And keep in mind that our strategy is to optimize and drive the net operating income on the asset. This is a business. The value of this asset is derived from the growth in the net operating income. So our goal is to optimize and grow that as quick as possible. And the metric that we look at is the internal rate of return. So we want to, perform and get as large of an internal rate of return as possible for our investors. And that means looking at the timeline. If we're able to optimize the NOI and exit this investment, month 36 instead of month 60, we're going to do that. And along the way, we'll be keeping our entire database and team in the investment apprised so that we can have adequate tax planning strategies in place.
And I do think it's important to explain a little bit about internal rate of return, because some people might not be familiar with that. But basically an internal rate of return is a measurement of time value of money. So the sooner we're able to return your money to you, the higher that number gets. And with a typical multifamily investment, you're looking for anything between 12 to 18% on an IRR. And as you can see, this exceeds that number. And so the expectation is that with the high distributions that you're getting, and with the sale, that you're getting a lot of bang for your buck, and you're not having to wait years for your returns. So just something to keep in mind.
Yeah, it's part of our underlying criteria for assets that we look for. We like being active in these different middle America markets: Cincinnati, Minneapolis, Indianapolis, because they are high yield, high cash flow markets where we're able to go in and reap the benefits of in-place cash flow that is strong, versus a lot of other markets, the Sun Belt, Florida, Phoenix, those areas that those returns on their projections are based on this overall market appreciation. And they're not banking on that high cash flow. So a lot of times they might have actual negative leverage, which means that essentially the interest rate is higher than the cap rate that they're going in, not cash flowing assets. So that's great if the market is just going gangbusters the whole time, but for strong risk adjusted returns, we like the cash flowing properties the best. And if it continues to appreciate at the pace that we've seen, that's great. If not, our deal is still strong, and that's what we underwrite. Who is doing the work for the improvements? A number of the in-unit improvements are being done by the property management team, their in-house team, because they are fairly basic. Installing new stainless appliances, cabinetry, cabinet hardware, paint, that type of stuff. The work on the exteriors, the dog run, we're bidding those out right now and have a few very strong subcontractors and contractors in the market that'll be doing that work.
And I do have another question. What are some headwinds that you guys could see possibly coming in the Minneapolis market in the next few years, if anything?
Headwinds. I think general uncertainty with the economy could provide some challenges, but overall, the markets that we are active in, even from the beginning of the pandemic through today, have all performed well above our expectations. We knew of many operators in different markets that had a really hard time throughout the pandemic. All of our resident base performed on time, and those that had any challenges were able to navigate the different assistance programs. So in terms of headwinds, we don't see anything really slowing multifamily. We see the proportion of people renting versus buying staying where it's at, if not growing for the renter side, just due to the challenges of the interest rate market. But from a commercial financing arrangement, we see a lot of feasible acquisition targets in this environment, even if the yields continue to increase, even if rates continue to go up, which they will. The Fed's going to raise rates again. Interest rates will continue to rise. So the only people that will really be getting hurt with that will be those that are trying to acquire their residential homes.
right. And another question I had, if a lot of the work has already been done, how can you justify the rent increases?
So this owner, the current seller of the property, is what you would consider a legacy owner. His rents hovers around $1,100 a rent. I'm sorry, $1,100 a month in rent in a market where they currently should be between $1,250 and $1,300 a month in rent, just to keep up with where the market's currently at. So we're not necessarily driving improvements to have this rent growth accelerate any further beyond than where they already should be at. For the type of improvements that we're putting into place, the rent growth should jump from $1,300 to about $1,500 a month in rent. We are underwriting $1,400 a month in rent after those renovations are done. Yeah, John. So the 30-year amortization rate is what is used to drive what the monthly payment is on the loan. And I can go over this here in a second with you. So basically, think of it as a 30-year loan, and that's how you generate what the monthly rates are for that. However, the loan term ends after 5 years. So basically, it's a way that allows us to increase the cash flow for the asset for that period of time, and allows us to reduce some of the risk associated with financing this asset. Now, for the first 18 months, the loan payments are derived from portions of interest and portions of principal that pay down the debt of that loan throughout that 30-year time horizon. Our payments for the first 18 months of that period is limited to just the interest portion of that loan. So therefore, it's also reducing the amount of our monthly mortgage payments even further, just to the interest portion. That is great because that allows us to execute our business plan where there might be some maybe increased vacancy while we turn over a unit or turn over some of the units and implement our business plan. It allows us to have that strong cash flow throughout that period because our debt is reduced for that first 18 months. After 18 months, we should have execute our business plan. All the units should be turned over and at the new market rates. And then it turns into the fully amortizing loan and our debt service increases slightly.
Any other questions? Feel free to unmute yourself or just pop it in the chat.
Say, Alex, you touched on earlier how the property management company is going to be a part of the GP, and maybe just going into that a little bit on how that benefits an LP. So this is not always the case, but when we can get, the third-party property management company a part of the GP, we really like that, not only for the alignment of interest, but basically they were able to give us, very favorable terms. And in exchange for that, they get that position on the GP, which doesn't affect a limited partner's returns at all. So basically they're giving us those discounted management rates. And if the property performs well, they're going to make that up on the back end. But again, that's great for the LPs. So
definitely, and it shows that they are aligned in the execution of the business plan. We are so Frank and I own East West Property Management and are co-managing this alongside Lion Rock Property Management in Minneapolis, and ensuring that they're able to execute the different pieces necessary, ensuring that they're having proactive property management, ensuring that they're enforcing different policies that are critical to the well-being of the residents in the space, and staying on top of different contractors or those individuals. So this allows us to have just an increased alignment of interest in this. And Bobby, you're asking why you guys have your own property management company by using third-party co-partnership. So those are not familiar with Minnesota. Our organization is based out of Duluth. We have tons of resources, a great vendor database, different subcontractors that we can call, at 2 a.m. if something happens. But our database is pretty concentrated to northern Minnesota. This asset is out of Minneapolis, Minnesota, further south. We have a really great relationship with Line Rock Property Management that strictly works out of the Minneapolis metro market. And they have all the resources in that market that we don't. And that is why we are working with co-partnering with a third-party property management firm in the area. And they've also executed this same business plan countless times on their own assets and assets for clients as well.
Any other questions?
Yeah. I just spoke on the Joe Fairless podcast last week, or just aired last week rather. But property management is truly the unsung hero of the execution of any business plan. They're the boots on the ground. They're the ones that are on the asset, ensuring its performance day in and day out. So it is really critical making sure that you're working with a very strong property management firm. And as we continue to grow within this market and every market that we invest in, we will continue to plant our own boots on the ground and build these relationships so that we can ensure that we have continued in-house management that allows us to stay on top of executing the business plan for these different assets. Any other common questions we get, Frank?
Nothing else has come. Let me do a quick check, but nothing else has come through. Nope, not since we started. So.
Okay.
Yeah, that's about all the ones that I've received as well.
Okay, we can press pause on the recording, and if anybody wants stick around after, have a conversation, I'd be open to it. We're pretty excited. So right now, we are finalizing the closing date. It's looking like we'll be closing on the asset either on the 15th or 18th of July. And we already have most of our pieces in place, so we can start executing the business plan day one. So excited to move forward. We're also looking at other opportunities. If you know of anybody with an apartment building, 85 units or greater, let us know. We'd be happy to take a look at that as well.
And I do think that brings up, you talk about the closing deadline. What is the actual funding deadline for this project for you guys?
Yeah, let me pull up the calendar here again. So we are, like I mentioned, let's plan on closing date of the 15th, which is a Friday. Means we'd like to have all funds in the escrow by the 8th. And it's a pretty seamless process. Executing subscription agreements can all be done online, provided any supporting or accreditation documentation can be uploaded directly to our portal. If you don't have access to our portal, you can go to grayduckcapital.com and select invest now, and you can fill out the request, and then we can get you set up there, and you can take care of all the necessary paperwork right on the website. If you'd like to schedule a one-on-one call with us, feel free to reach out by email, by phone, whatever works best for you guys.
And I'm also going to put a soft reserve link in here for folks that have been in contact with me, with On-Call Capital here. That link is going to be in the chat for those of you who are looking to make a soft reservation and wanting to proceed with this. So there you go. And from there, we get you all set up, ready to roll with the portal and everything else. So.
Okay. And there are our phone numbers, our personal cells. If you have any questions, feel free to shoot us a call or a text, and our website. And if there are no other questions, we can wish you all a great night. So I'm going to stop the recording, and we'll stick around for our